This is Al Brooks. Thank you for watching the Brooks Trading course. This is a preview sample of slides from How to Trade, videos 37A and 37B. In this video, I first am going to begin by talking about what markets can do. Every chart is a combination of either a strong breakout, a tight channel, which is a type of strong breakout, a broad channel, which has a lot of trading range price action, or a trading range. Some charts are exclusively only one of those four. Other charts have all four. Usually, strong breakouts occupy no more than 10% of the chart, and 90% of every chart is either in a trading range or in a channel. Next, I'm going to be talking about using the market cycle to determine how to trade. So if the market's in a breakout or in a very strong channel, a very tight channel, traders should only trade in the direction of the trend. On the other hand, if the market is in a fairly broad trend channel, it's still in a trend, so you should always trade in the direction of the trend, but you can usually trade in the opposite direction as well, at least for scalps. Finally, if the market's in a trading range, traders look to buy low, sell high, and scalp. I'm going to also talk a little bit about the trader's equation, which is the mathematical basis of every trade, and I'll talk about the 40-60 rule. The 40-60 rule means that the probability during 90% of the bars on the chart, the probability is always between 40 and 60%, which means that you can usually structure a profitable trade buying or selling during 90% of the bars on the chart. Finally, I'll move on and talk about default targets. You always have to have defaults, your routine plan that you use when you're not sure what to do. Take a look at this chart. The low of this bar is above the low of that bar. And for 16 bars, the market did that. It's a bull microchannel, no pullbacks. Chances are bulls have been buying at or above the low of the prior bar, and now they finally get a chance to buy the low of the prior bar. Chances are they'll buy it. Yet the market's telling you they're not buying it. Chances are means high probability there are buyers below. Yet once you start to see 2, 3, 4 bear bars closing on their lows and the body's getting bigger, the market is telling you it doesn't matter what you thought was likely. If you keep denying that the market can go down and you keep buying, you're going to lose money. Price is truth. If the market's going down, you have to sell. It doesn't matter if it doesn't make sense. If it's going down, you have to sell. And as long as a trader is in denial that the market is doing something, he's going to be experiencing a lot of pain, and it's called a pain trade. So whenever a low probability event starts to unfold, you cannot remain in denial. You have to look at the chart and say, hey, I know it's supposed to go up, but it's not going up, it's going down. And when that happens, no matter how unlikely something appears to be, you have to look at the chart and believe the chart. The price is truth, not your instinct. You have to trade what you see, not what you expect to see or hope to see. So 16 bar bull microchannel, yet a bear reversal. And by the time you get the third consecutive bear close on the low, especially with the bigger bear body, you have to be thinking it's going down. You got to sell. So you sell the close. That's a reasonable way to approach that. And then here we have a very tight bear channel. It's a bear micro channel to this point, 7 consecutive bars without a pullback. Then we have a little pullback here and then down another bar. So it's a very tight bear channel, also a very strong channel. Chances are the first bull breakout will be a bear flag and will continue down. That's what the probability is. That is true. But that is not an absolute guarantee. If the market starts to have 2, 3, 4, 5 consecutive bull bars, you have to say, this is one of those times when there are not sellers above. It's going up. So at some point, you have to decide that the probability is wrong. It's the low probability event is taking place. So you got to buy. Maybe the 4th or 5th close, you just buy the close and don't question that the market should not be doing what it's doing. It's doing it. You got to do what the market tells you it's doing. Price is truth, not what you believe probabilities are. Here, a very strong outside down bar, yet the next bar is a bull inside bar. So the market's going up. Doesn't matter if this is a big bear bar, the market's going up. You got to buy. And here we have a pair of very strong bull bars breaking above the top of this trading range. So theoretically, it's going up. Chances are this is a measuring gap, not an exhaustion gap. Yet, once you start to see 1, 2, 3 bear bars, 4 bear bars, bodies getting bigger, closing on their lows, it doesn't matter what the probability is. It's going down. You have to sell. Now, look at this chart. Very strong breakout. Now, how many bars on this chart are in a very strong breakout? Maybe 100 bars on the chart. Here we got 4 or 5 bars in a strong breakout. In general, on any chart, only 5 to 10% of the bars are in a strong breakout. And when they are, you only want to be trading with the trend. 90% of the bars in the chart are either in a trading range or a channel. And that is when my 40-60 rule applies. Bulls and bears can make money taking opposite sides, and it doesn't matter which side you take. So anywhere through here, if you structure your trade correctly and manage it well, you can make money buying or selling here or here or here or here. Same with here. And it doesn't matter whether you buy or sell. And it doesn't matter which bar you choose for your entry. 90% of the bars on any chart you can buy or sell and make money if you manage your trade well. Here we have a bear trend, a very strong breakout and a higher low. You can call it a head and shoulders bottom if you want. Doesn't matter. It's a higher low major trend reversal. It's a pullback from a very strong bull breakout, around a 50% pullback. The earliest entry is buying with a stop above the high of the prior bar. The risk is small, either to this low, which is the best stop, maybe to below the low of the signal bar. Small risk, big reward, great risk reward. That always comes with low probability. Whenever you have a great risk reward for your trade, you know the probability of making money is small. If you wait to buy during the breakout, you stop as much further away, the risk is greater, and there's less profit left. The reward is less. So the risk reward is worse buying during the breakout phase, but the probability of making money is much higher. And that always is the case. Whenever you have a high probability trade, the risk reward is bad. Whenever you have a low probability trade, the risk reward is good. Both are acceptable, again, if you manage them correctly. So let's say you buy this higher low major trend reversal. It's a weak buy signal bar, a doji instead of a bull bar, and it's following a pretty strong bear bar, so the probability is low. In general, whenever you're taking a low probability trade, you need to get a reward equal to at least 2 times your actual risk. So let's say you buy above the high of this bar. Your actual risk was just below the low of that bar. Let's use your initial risk. You can call it actual risk. It's about the same. So you buy here on this bar. Stop is here. This is 1 times your risk. That's 2 times your risk. And if you hold for a reward that is equal to 2 times your risk, even in a low probability trade, a 40% trade, the math is good for making money. So it is an appropriate thing to do. A very strong breakout like this, do you really want to take your profits here? You can, the math is okay, but the minimum profit is usually not the optimum profit. When you see a strong reversal like this, yes, you can get out at 2 times your risk, but chances are the market's going to go higher. If you can, try to hold for a bigger profit. Let's say you sold right here, your stop is above there. That's your initial risk, the height of that red rectangle. And there are lots of ways to take profits, and none of them is perfect, but it's good to have a default plan, a basic plan that you use whenever you're not sure what to do. And you can change the targets based upon support and resistance or the momentum that the market has. Most traders are not particularly good about determining probability. As I said, 90% of the bars on the chart, the probability is between 40 and 60% that you'll make a profitable trade, or that the market will continue or go the direction that you expect it to go before it hits your stop. Well, let's say you sell here, your initial risk is there. If you cannot decide where you should take profits, a good default is always 2 times your initial risk. There's your initial risk, here's 1 times, here's 2 times. So that's a reasonable location to take profits. So on any trade, if you cannot decide where you should be taking profits, it's always good to take at least partial profits at 2 times your initial risk. And I say always because let's say you're taking a trade that turns out to be a low probability trade, and you were not sure that it was low probability when you entered the trade. Low probability is 40%. The trader's equation math is always good if you're going for a reward equal to 2 times actual risk. Initial risk is always greater than actual risk. If your default plan is to go for a profit that is 2 times initial risk, the math is always going to be good. Here's 3 times initial risk. So a reasonable approach is to take half off at 2 times your initial risk, and then take another half off or 25% more off at 3 times initial risk. And then let's say you take a quarter off here, and then you just swing the balance and you rely on your protective stop. After every strong breakout to a new low, you have a new major lower high. So you lower your stop to just above that new lower high. Toward the end of the session, you look for any reason to exit. For example, a new low, reversal up. In this video, I talked about the 4 things that the market can do, and those are the only 4 things the market can do. It can be in a strong breakout up or down. It can be in a tight channel up or down, which is a strong breakout on a higher time frame chart. Next, it could be in a broad channel up or down, or it can be in a trading range. When it's in a strong breakout, traders should only trade in the direction of the trend. When it's in a pretty tight channel, they should also only trade in the direction of the trend, because a tight channel is a breakout on a higher time frame chart. A broad channel usually has moves against the trend that are big enough so that a trader can trade in both directions. And then in a trading range, a trading retake. And then in a trading range, traders can buy or sell. They want to buy low, sell high, and scalp. I then talked about the trader's equation, which is the mathematical basis for every trade, and the 40-60 rule. During 10% of the bars on any chart, the market's in a strong breakout, and a trader should only trade in the direction of the trend. However, during 90% of the bars on the chart, the probability of an up move or a down move is between 40 and 60%. And therefore, during 90% of the bars on the chart, a trader can structure a profitable long trade or a profitable short trade. Finally, I talked about some reasonable default targets. Everyone should always have a plan, and if you cannot figure out what an ideal target is at any given moment, you can rely on some defaults. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is a preview sample on how to trade. It contains slides from videos 37A and 37B.